Today, we're going to break down the absolutely shocking 48-hour collapse of Silicon Valley Bank. This was a pillar of the tech world that, well, in the time it takes to get through a weekend, it just vanished. So let's start with a number, $15 billion. That was the market value of Silicon Valley Bank on a Thursday morning. Looked like a healthy, thriving bank, right? Or so it seemed. But you know, in the crazy fast world of digital finance, things can change in an instant. The trust that holds a bank together, it can evaporate at the speed of a tweet. And by Friday, that $15 billion was gone. Zero. This is the story of how a major American bank, we're talking the 16th largest in the entire country, disappeared in less than 2 days. It triggered the biggest bank failure since the 2008 financial crisis. So who exactly was Silicon Valley Bank, and why did its collapse send these massive shockwaves through the entire global tech industry? Okay, so SVB wasn't just another bank on the corner. No, it was woven deep into the fabric of innovation. For almost 40 years, it was the financial backbone for a whole generation of startups and VCs. I mean, if you were in tech, there was a very good chance you were banking with SVB. But underneath this incredible success story, a huge vulnerability was growing. And it was tied to a very common and usually very safe financial tool that basically became a ticking time bomb. So to really get this, we first need to talk about long-term bonds. Just think of them as super safe loans. A bank like SVB buys these bonds, and then they collect a steady, fixed interest payment over a long time. Now, back when interest rates were near zero, SVB just gobbled these things up. So, if bonds are supposed to be the safe bet, what went so terribly wrong for Silicon Valley Bank? Well, the answer actually lies in one of the most basic principles of finance. This slide shows it all right here. A massive gap opened up. See, to fight inflation, the Federal Reserve started hiking interest rates, and they did it aggressively. All of a sudden, SVB's older bonds, which were locked in at a really low 1.79% yield, became way less valuable. I mean, why would anyone buy their old, low-paying bond when they could just get a new one paying more than double? The simple answer is they wouldn't, unless SVB sold them at a huge discount. And this created a giant, hidden hole in their balance sheet. They couldn't sell these bonds without taking a massive loss. Now, as long as they held onto them, the loss was just on paper. It's what we call an unrealized loss. But the second they were forced to sell to get cash, that theoretical paper loss would become very, very real. So you've got this hidden vulnerability just sitting there, kind of like a pile of dry tinder, and all it needed was a single spark to turn it into a full-blown inferno. And that spark came on Wednesday, March 8th. The bank announced it had been forced to sell a huge chunk of its bond portfolio at a nearly $2 billion loss, and that it needed to raise more capital. This attempt to look stronger had the exact opposite effect. It was basically a public admission of weakness, and it triggered absolute panic among its very tech-savvy clients. What happened next perfectly illustrates the terrifying speed of modern finance. This wasn't just a bank run, it was a bank sprint, completely fueled by social media and instant messages. This timeline shows the complete meltdown in real time. By Thursday morning, really influential venture capitalists started telling their companies, get your money out, now. The news just spread like wildfire on Twitter, on Slack. The digital herd started running. And by that afternoon, it was a stampede that nobody could control. $42 billion. That is the staggering amount that customers tried to pull out on Thursday alone. It was the single largest bank run in U.S. history, and it all went down in just a matter of hours. So what SVB experienced was a classic bank run, but it was supercharged by 21st century speed. Instead of people lining up for blocks around the bank, withdrawals happened with just a few clicks on a phone. And that turned a potential crisis into a completely unstoppable collapse. The bank's CEO actually held a conference call, pleading with clients and investors to please stay calm. But it was just way, way too late. The damage was done, the fear was out of the bottle, and his words just fell on deaf ears. The collapse of America's 16th largest bank, well, it wasn't an isolated event. Its failure immediately sent these tremors of fear rippling across the entire global financial system. The immediate fear was contagion. Would other banks fall? As you can see right here, stocks of other regional U.S. banks like First Republic and PacWest just plummeted. The fear even jumped across the Atlantic, hitting major European banking indexes. With nearly $500 billion wiped off the value of global financial stocks, investors were scrambling for safety. Money poured out of banks and into assets that are seen as safe havens during a crisis. Things like gold and, in a very modern twist, even cryptocurrencies like Bitcoin. So, what can we all take away from this spectacular failure? Well, this whole episode offers some pretty crucial lessons for investors, for companies, and for regulators too. So, what are the big lessons here? First, the hidden danger of bonds when interest rates are going up. Second, the risk of putting all your eggs in one basket. SVB's fate was completely tied to the tech industry. And finally, the terrifying new reality of digital speed. A bank run used to take days. Now it can happen in a matter of hours. And that leaves us with a final, really provocative question. The day before it collapsed, a well-known venture capitalist actually claimed SVB was too big to fail. Its collapse proved that in the 21st century, fear travels way faster than any bailout. In an age of instant communication, is any institution truly safe from a digital bank run?